Welcome to Daily Crypto episode 31. We're about to embark on a really comprehensive deep dive into the very latest currents shaping the cryptocurrency world right now. Think of this as your essential shortcut to understanding the digital asset landscape, cutting through the noise to get to the core insights.
It's pretty remarkable how much ground we can cover in a single deep dive, isn't it? From those minute-by-minute market movements we often obsess over, to the really big regulatory shifts, groundbreaking tech advancements, and even that pervasive speculative buzz that drives so much of this space. Our mission today really is to extract the most important nuggets of knowledge, give you that crucial context, and maybe highlight those aha moments that make this complex field just, well, so much clearer and more intuitive.
Absolutely. So let's unpack this. We've got a lot to explore. From the titans like Bitcoin and Ethereum to, the emerging altcoins and meme tokens that seem to dominate so much conversation these days, we'll blend critical news analysis with market insights and take a close look at what's truly driving investor sentiment. We'll be connecting the dots for you, revealing patterns, and giving you a clear, full picture of what's happening in crypto right now. The immediate market pulse, a snapshot of today's crypto prices. Okay, let's kick things off with the most immediate market data, a direct look at how some of the top cryptocurrencies are performing right now. This gives us a quick temperature check on the overall market mood, and, well, it often tells us a lot about current investor sentiment, doesn't it?
Yeah, looking at these immediate values,
Hmm.
a key observation here is a general downtrend across the board, which naturally leads us to ask, what's truly driving these immediate fluctuations? It's fairly rare, to see so many major assets, and especially the more speculative ones, all moving in the same negative direction like this all at once. It suggests a broader underlying current, I think.
So let's get into the specifics of this current. Bitcoin, still the undisputed king, currently sitting at $103,527, showing a negative 2.71061% change. Now, even a seemingly small dip for Bitcoin can mean a significant amount of capital shifting. What does this modest decline tell us about the broader market sentiment, especially considering its sheer size?
You're absolutely right. Even a slight percentage drop for Bitcoin translates into, well, substantial value shifts, given its incredibly high price point. A 2.71% decline on an asset valued over $100,000,
Yeah.
that's a lot of money on the move. This kind of movement often signals a cautious or sort of risk-off mood among larger institutional investors. Perhaps they're reacting to specific news events we'll dig into later. Bitcoin's movements are just incredibly indicative of broader trends because of its dominant market cap and trading volume. You know the saying when Bitcoin sneezes.
The altcoins catch a cold.
Yeah,
Sets the tone for the whole ecosystem.
exactly.
Speaking of altcoins, Ethereum, the second largest cryptocurrency, is standing at $2,427.63. But with a more pronounced 95.1723% change, Ethereum's drop is noticeably steeper than Bitcoin's. Is there a specific reason for this, or is it simply part of a larger market correction we're seeing today?
Well, Ethereum often experiences larger percentage swings compared to Bitcoin, and there are a few reasons for that. It's partly due to its vast and, frankly, complex ecosystem.
Mm.
I mean, think of all the decentralized apps, NFTs, and DeFi protocols built on or heavily reliant on Ethereum. Its performance kind of acts as a barometer for sentiment across a much wider range of crypto activities. So a larger dip here could point to profit-taking by investors who've seen good gains, or it could be a reaction to specific developments within the DeFi space, which is just so intrinsically linked to Ethereum's infrastructure. It's less of a blip and more of a reflection of the health of that entire interconnected sector.
Right. Let's pivot to BNB then. It's at $640.90, experiencing a more modest Mergus 1.30247% change. BNB seems to be holding its ground a bit better compared to both BTC and ETH. Does its performance often diverge from the broader market, or is this particular movement maybe just an anomaly for BNB?
BNB, well, being tightly integrated with the Binance ecosystem, which, includes the world's largest crypto exchange, it can indeed exhibit slightly different market dynamics. Its performance is often influenced by factors unique to Binance's platform and its services. Things like trading fee discounts, participation in new token launches on Binance Launchpad, and general utility within the Binance Smart Chain. Its relatively smaller decline compared to Ethereum, for instance, might suggest a more localized strength or stability, maybe stemming from its dedicated user base and specific use cases within the Binance network, making it perhaps less susceptible to the broader market's immediate volatility.
Then we have Solana, priced at $140.59, with a negative 4.85124% change. Solana's decline is quite similar to Ethereum's in percentage terms. What's the context here? Especially given Solana's, well, significant growth and increasing popularity recently as a fast, low-cost alternative.
Yeah, Solana has undeniably seen tremendous adoption and developer activity. It's built a strong reputation as a high-performance blockchain. That fundamental growth is a very positive long-term signal, absolutely. However, this current decline, even with strong fundamentals, just highlights how even promising projects aren't entirely immune to market-wide sell-offs or broader shifts in investor sentiment. When the overall crypto market trends downwards, high-performing assets like Solana can still get caught in that wider tide as investors, across the board, de-risk their portfolios, regardless of individual project strengths.
Right, it's a reminder.
Exactly. It's a reminder that even the best projects feel the gravity of a bearish market.
Next up, XRP. Currently at $2.14, with a negative 1.75397% change. XRP's dip seems relatively contained compared to some others we've discussed. Any particular insights that might explain its more stable movement today?
Well, XRP's price movements can often be uniquely influenced by ongoing regulatory discussions, particularly its long-standing legal battles in the U.S., and also its specific use cases in cross-border payments. Unlike many other cryptocurrencies, a significant chunk of its investor base might be more focused on its utility and long-term potential within traditional finance, rather than just speculative gains. Its more stable percentage change today might suggest a distinct investor base with a long-term view, or perhaps less immediate reaction to daily market swings compared to, say, highly speculative assets, or those tied more directly to the DeFi ecosystem. It marches to its own drum to some extent.
Okay. Now let's talk about the meme coins. We're seeing a range of them all in the red. Shiba Inu, SAA, at 0.000112, down negative 3.28349%. Pepe, PPE, at 0.000001, down negative 4.01169%. Bonk, BONK, at 0.0000137, showing the largest drop at negative 5.75822%. Dog with Hat, WYF, at 0.7703, down negative 4.97399%. And PopCat, People Cat, at 0.282358, down negative 4.95231%. What's your general takeaway from these numbers for the meme coin sector? Quite a bit of red there.
Meme coins are, well, notoriously volatile, even on a good day, let's be honest. Their price action is driven primarily by social media trends, community hype, and just pure speculation, rather than, traditional underlying tech or utility. Think of them as the water market downtrends because, well, in a cautious or risk-off market, these assets are typically among the first to see widespread sell-offs. When faced with uncertainty, investors tend to de-risk by shedding their most speculative and least fundamentally backed positions.
And meme coins definitely fit that bill.
They squarely fall into that category, yeah. This makes them highly susceptible to exaggerated price movements, both up and down, especially when the market turns.
So we're looking at a pretty noticeable sea of red across the board right now. For you, the learner, keeping an eye on this space, what's crucial to remember from this market overview?
This initial market snapshot really underscores the dynamic and, let's face it, often highly volatile nature of cryptocurrency. But understand that today's sea of red isn't just about selling. It's about which underlying narratives might be gaining traction, which tech is truly evolving, and how macroeconomics are filtering down. The real insight isn't just in knowing prices, but in discerning those tectonic shifts beneath them, because that's where long-term value is truly built, not in chasing every fleeting percentage. The immediate numbers are a symptom, not the whole story. Understanding these deeper drivers is exactly what we'll do next as we dive into the news and trends shaping these movements. 2. Navigating the latest news, key trends and headlines.
Right.
Now, the real story often lies beneath the surface prices. Let's dig into some of the specific news items that are truly shaping these market movements and the broader crypto narrative. This is where we get to unpack the why behind the numbers and look beyond those surface-level movements.
Exactly. Looking beyond the price charts, the headlines themselves offer, well, a kaleidoscope of stories, touching on everything from deep technological advancements and major regulatory milestones to, unfortunately, critical security concerns. It really begs the question, how do these seemingly disparate developments collectively shape crypto's future? And what do they tell us about the ecosystem's direction? Each piece of news, whether big or small, adds another brushstroke to the evolving portrait of this digital financial landscape, Ethereum ecosystem developments.
Let's start with a truly significant development for the Ethereum network. The amount of staked ETH has now passed a major milestone, eclipsing 35 million ETH. This record high is reportedly fueling a supply squeeze. Over 35 million ETH now staked. What are the core implications of that for the circulating supply and, more broadly, for the network itself? Right, so when we talk about staking Ethereum, we mean locking up your ETH to support the network's operations, specifically validating transactions and securing the blockchain. And in return, you earn rewards. With over 35 million ETH now staked, that significantly reduces the circulating supply available for trading on exchanges. This supply squeeze, as they call it, could, in theory, contribute to price appreciation if demand stays constant or grows, simply because there's less supply to meet it. But beyond just price, this record level of staking is profoundly significant for the network's health and long-term viability. It directly enhances network security because, well, the more ETH staked, the more difficult and costly it becomes for a malicious actor to gain enough control to attack the network.
Makes sense.
And it also strengthens decentralization, as more participants are incentivized to validate transactions and contribute to the network's integrity. This level of commitment from a growing number of holders demonstrates, I think, profound long-term confidence in Ethereum's future and its crucial role as a foundational layer for Web3. B. Solana's ascendance and strategic moves.
Okay, shifting our focus to Solana now. The platform is highlighting some pretty impressive figures. 3,200 active developers and over $1 billion in app revenue for the second straight quarter. These are robust numbers for any blockchain. What do these figures truly tell us about Solana's health and its competitiveness in that Layer 1 blockchain space?
Those figures are indeed incredibly strong indicators of a vibrant and innovative ecosystem. Active developers is a critical metric for any blockchain because it directly correlates with the creation of new applications, features, functionalities, you name it. A growing developer base signals sustained innovation and a healthy pipeline of projects choosing to build on Solana. And app revenue shows real-world utility and economic activity. It indicates that users aren't just experimenting, but are engaging in financially meaningful ways. This sustained developer interest and revenue generation are absolutely critical for Solana's long-term viability and its ability to compete effectively against other major Layer 1s like Ethereum, Avalanche, or Cardano.
Right, it shows real adoption, not just hype.
Exactly. It shows adoption beyond mere speculation, demonstrating actual utility.
And it's not just developers. Solana is also making moves on the governmental front. Solana and Aptos have tied for the top spot in Wyoming's hunt for a WYST stablecoin partner. This suggests a growing interest from state entities in using blockchain tech. What could a WYST stablecoin actually mean for broader state-backed digital currency experiments across the U.S.?
That is a fascinating development, and it signals a potentially significant step towards mainstream adoption and legitimization of blockchain technology at a governmental level. Wyoming, as you know, has consistently been at the forefront of progressive crypto laws in the U.S., so their interest isn't entirely surprising, I suppose. A WYS stablecoin would likely be a state-backed digital currency, probably pegged to the U.S. dollar, that leverages blockchain for its efficiency, transparency, and immutability. Such a partnership could pave the way for more official use cases of blockchain, like streamlining state payments, digital identity, or even issuing digital bonds. It represents a validation of blockchain as serious tech infrastructure, not just a tool for speculative assets, and it could definitely set a precedent for other states.
Okay, perhaps the most anticipated news for Solana and other altcoins too is the analyst estimate of a 95% chance of SOL, LTC, and XRP ETF approval. With analysts putting such high odds on these new ETFs, what would be the most significant impact of such an approval on the broader crypto market and its accessibility? That 95% figure sounds huge.
Oh, it is. When analysts talk about a 95% chance for an ETF, it signals a massive potential shift. Remember, an ETF isn't just another way to buy crypto. It's a regulated financial vehicle. It basically throws open the doors for mainstream institutional money, think pension funds, mutual funds, even everyday retail investors who prefer traditional brokerage accounts. It lets them gain exposure to cryptocurrencies without directly owning or managing the underlying crypto assets themselves.
Much simpler for many people.
Way simpler. They can just buy shares of the ETF through their existing investment platforms. High odds of ETF approval would dramatically broaden the investor base for these cryptocurrencies, potentially leading to a massive influx of institutional investment and, ideally, greater price stability as more diversified capital enters the market. This truly represents a monumental step for mainstream integration, bridging that gap between traditional finance and the crypto world. see Bitcoin's expanding reach and investment.
And beyond individual investors, we're seeing more traditional companies and even stock exchanges wanting a piece of Bitcoin. KindlyMD and Nakamoto have secured $51.5 million more for a Bitcoin push, and Parataxi sealed an $18 million deal to launch a Bitcoin treasury on KO's DQ. This isn't just about individual speculation anymore, is it? Feels like a deeper institutional embrace.
You hit on a critical point there. These moves signal a profound and growing institutional embrace of Bitcoin. When we talk about a Bitcoin push or a Bitcoin treasury, it often entails corporations allocating Bitcoin to their balance sheets as a strategic asset, similar to how they might hold gold or cash, or leveraging blockchain technology for new business ventures. KOSAQ, for example, that's a major stock exchange in South Korea. An $18 million deal to launch a Bitcoin treasury there is a significant indicator that Bitcoin is moving beyond just being a speculative commodity. It's becoming a foundational technology and a strategic financial tool for established enterprises and traditional financial markets. This underscores the growing confidence in Bitcoin as a digital asset, not just for trading, but for enterprise applications and long-term financial strategy. So no, definitely not just about individual investors anymore. Deregulatory landscape and geopolitical influences.
Okay, shifting gears to the regulatory landscape now. Coinbase has secured a MiCA license in Luxembourg. This feels like a big step for them, especially in Europe. What exactly is MiCA, and why is this particular license so significant for a company like Coinbase?
Right, MiCA, or Markets in Crypto Assets, is a groundbreaking, comprehensive regulatory framework established by the European Union. It's designed to provide a unified set of rules for crypto asset markets across all 27 EU member states, bringing much-needed legal clarity and consumer protection to the space. Securing a license from Luxembourg, which is a major financial hub in Europe, is immensely significant. It allows Coinbase to operate under clear, unified rules across the entire European Union. This dramatically reduces regulatory uncertainty, which, has historically been a major hurdle for crypto businesses.
Huge deal for expansion.
Exactly. It potentially expands Coinbase's market reach to millions of users under a consistent regulatory umbrella. It highlights a growing trend of major crypto firms actively seeking formal regulatory approval to ensure legitimacy and broaden their market access globally.
Okay, but on the flip side of regulation, we're seeing news about Russia's crypto exchange Garantex. Despite a stablecoin ban, blockchain data shows it's still moving millions. The source notes Garantex might have lost $26 million in frozen tether, but still moves $15 million in crypto. This points to the inherent challenges of enforcing crypto bans, doesn't it?
It absolutely does. This situation with Garantex underscores the inherent challenge of enforcing crypto bans and sanctions due to the, permissionless and decentralized nature of blockchain technology. Despite official government restrictions, on-chain data can often reveal continued activity, demonstrating that while governments can make laws, completely stopping crypto transactions is incredibly difficult. This highlights that dual nature of crypto. It's a powerful tool for innovation and financial freedom, but its inherent borderlessness also allows it to be a potential workaround for sanctions or capital controls, posing complex dilemmas for regulators worldwide.
And the fact they still move $15 million after losing $26 million.
Yeah, the fact that they still move $15 million in crypto despite previous frozen funds is a testament to this resilience and, frankly, a headache for those trying to enforce bans.
And it's not just Russia. We're seeing a global patchwork of regulations emerge. Thailand's SEC is launching public consultation on stricter crypto listing rules. Norway is banning new power-intensive crypto mining to conserve electricity. And the Bank of England governor is casting doubt on the case for retail central bank digital currencies, or CBDCs. What do these diverse actions tell us about the global approach to crypto? How fragmented is it really?
These are prime examples of how different nations are grappling with various aspects of crypto regulation. From Thailand focusing on market listing standards to ensure consumer protection and prevent scams, to Norway addressing the environmental impact of energy-intensive crypto mining. And then a major central bank expressing skepticism about direct retail CBDCs. Each country is carving its own path based on its own priorities and economic circumstances. This patchwork of regulations creates both opportunities and hurdles for crypto companies and users. It signals that a universally harmonized global approach to crypto regulation is still, a distant prospect, creating complexities for international businesses and highlighting the diverse priorities of different governments. It's a complex and ever-changing landscape.
It's also fascinating how global events, things happening completely outside of crypto, can ripple through this market. We're seeing headlines like Dow Jones major indices gain as Trump holds off Iran strikes and the Federal Reserve balances Iran tensions.
Hmm.
How does the Dow's movement or geopolitical stability really affect Bitcoin and the broader crypto market? Is there a direct link?
Indirectly, yes, and quite significantly sometimes. While crypto aims for decentralization and being separate from traditional finance, it's not entirely decoupled. Not yet, anyway. Major geopolitical stability, or conversely instability, as well as shifts in traditional economic policy by central banks like the Fed, can profoundly influence investor risk appetite across all asset classes, including crypto. When traditional markets gain, it often signals broader confidence and a risk-on environment, which can extend to digital assets as investors are more willing to seek higher returns. If tensions ease or economic outlooks improve, capital often flows into riskier assets, and crypto is frequently viewed as a high-beta, higher-risk asset.
So it's about overall risk appetite.
Exactly. So while the connection isn't always direct or immediate, the broader macro environment plays a crucial role in shaping crypto market sentiment, influencing how willing investors are to take on risk. Security challenges and industry vigilance.
Moving to a more somber but crucial topic, security. We've seen the full story behind the $90 million Novotix hack that shattered Iran's crypto illusion. This is a stark reminder of persistent risks. What are the key takeaways from such a large-scale hack, and why are centralized exchanges particularly vulnerable?
Yeah, this serves as an incredibly stark reminder of the persistent and, frankly, evolving security risks within the crypto space, particularly for centralized exchanges. A $90 million hack is a massive blow, not just financially, but it profoundly impacts user trust and confidence in the platform and, by extension, the broader industry. Centralized exchanges are particularly vulnerable because they hold large amounts of user funds in hot and cold wallets, acting as honeypots for malicious actors. Unlike decentralized systems where users control their own keys, centralized exchanges are single points of failure. The key takeaways are the critical need for robust, multi-layered security measures, continuous auditing, and rigorous due diligence, especially in regions with less regulatory oversight where users might have fewer protections. It underscores that while blockchain tech itself is incredibly secure, the human-built interfaces and centralized custodians that interact with it can be vulnerable.
And the threats are getting more sophisticated, too. CZ, the founder of Binance, warns of AI deepfakes as more executives fall victim to Lazarus-linked Zoom hacks. Also, we're seeing fake AV ads appearing at the top of Google's search results, prompting fears of phishing attacks. So hackers are getting more sophisticated, using AI, even faking legitimate ads. For you, the average user, what are the most critical steps to protect yourself against these increasingly advanced threats?
It's truly a constant battle, and the sophistication of these attacks is definitely rising. The use of AI deepfakes by groups like North Korea's Lazarus Group for social engineering against high-value individuals is deeply concerning, as it exploits human trust. I've even heard stories of sophisticated attacks where AI was used to perfectly mimic someone's voice for a phishing call. It's like something out of a sci-fi movie, but it's the reality we live in now.
Scary stuff.
It is. Similarly, fake ads appearing on trusted search engines like Google are a common and effective vector for crypto scams, tricking users into revealing sensitive info or connecting to malicious sites that mimic legitimate ones like NEF. The key for you, the user, is extreme skepticism and relentless vigilance. Always double-check URLs before clicking, especially if it involves connecting your wallet or entering private keys. Use official apps downloaded from verified app stores. Be wary of any unsolicited requests for personal information, private keys, or seed phrases. Remember, the human element is often the weakest link in the security chain, making these social engineering attacks particularly effective. Verify, verify, verify. If something feels off, it probably is. Market dynamics and investor behavior.
Okay, let's turn to some interesting market dynamics and investor behavior. We're seeing headlines like, Polkadot hits oversold extremes, is a rebound imminent? And then, Rex's finance rockets 325%, blow off top or just getting started, or here's why the Kaya price has gone parabolic. What do these technical terms and rapid price movements tell us about the crypto market's short-term nature? Seems very reactive.
These headlines perfectly illustrate the highly speculative and volatile nature of short-term crypto market movements. Oversold is a technical analysis term indicating that an asset's price has fallen significantly, perhaps beyond what its fundamentals suggest, and may be due for a rebound as buyers step in. This points to technical indicators heavily influencing trader behavior. On the other hand, the 325% rocket of Rex's finance, or Kaya going parabolic, showcases the massive, often unsustainable short-term gains possible with smaller cap or newly launched projects. A blow off top implies a sudden, sharp peak, followed by an equally sharp decline, typical of highly speculative assets driven by hype rather than intrinsic value.
So opportunities for traders, maybe risks for others.
Exactly. For day traders, these wild swings are opportunities. But for you, the long-term learner, remember, these parabolic moves are often just speculative sugar rushes that fade. Your job is to filter that noise and focus on what's truly building enduring value, not just chasing quick profits.
We also hear Bitcoin demand hits record low as short-term holders dump. This sounds like a cautious signal. What are the implications if demand is low and recent buyers are selling off?
This suggests a period of decreased interest from new buyers entering the market, combined with selling pressure from those who acquired Bitcoin more recently, the short-term holders.
Wow.
This combination can lead to a consolidation phase, where the price moves sideways, or it could signal the potential for further price dips if fundamental demand doesn't pick up soon. It indicates a waning enthusiasm from the segment of the market most prone to rapid buying and selling, and can precede a period of lower volatility or continued bearish sentiment until new catalysts emerge to attract fresh capital. It's a moment where the market is kind of looking for its next direction.
Okay, but on a more optimistic note, surprise Fed statement sparks hopes of Bitcoin and altcoin rally. How does a statement from the Federal Reserve, a traditional central bank, influence the crypto market, which is supposed to be decentralized and independent? Seems counterintuitive.
Well, it reinforces the idea that crypto, despite its decentralization ethos, is not entirely decoupled from traditional financial markets or macroeconomic forces. Not yet, anyway. The Federal Reserve's statements on monetary policy, things like interest rates, quantitative easing, or inflation targets, directly impact the broader financial landscape, including investor risk appetite. Positive signals, like a hint at lower interest rates or a more accommodative stance, can boost investor confidence across all asset classes, leading to a risk-on environment. In such scenarios, capital often flows into riskier assets like cryptocurrencies, sparking rally hopes for both Bitcoin and altcoins. It shows the strong interconnectedness between macroeconomics and crypto market sentiment, illustrating that even in a decentralized world, the ripples from traditional finance can be significant.
And finally, a few specific price action points. Dogecoin price nears breaking point as price action tightens within a bearish pattern. Cardano price flirts with make or break level, is a reversal incoming. And on the positive side, here's why Bitcoin cash price is eyeing a 35% surge. What do these technical analyses tell us about how traders are looking at these assets and what's really at stake at these levels?
These are classic examples of technical analysis patterns that traders, both professional and amateur, use to try and predict future price movements. A bearish pattern for Dogecoin suggests that based on historical price charts and volume, a further decline is considered more likely than an upward move. A make-or-break level for Cardano indicates a critical price point where the asset could either find strong support and rebound or break down and fall further, creating a significant trading opportunity or risk. And the 35% surge prediction for Bitcoin Cash, well, while specific reasons aren't provided in the headline, it reflects the constant speculative analysis within the market, often based on charting patterns or perceived catalysts. These highlight how technical indicators heavily inform short-term trading decisions and shape market expectations for even established cryptocurrencies. It's a high-stakes game of prediction and reaction.
So many different forces at play. Technical charts, whale movements, central bank announcements, geopolitical events. For you, the learner, how do you discern what's truly important for your understanding and what's just noise in this whirlwind? It can feel overwhelming.
Yeah, it can. It really comes down to identifying the underlying drivers and trying to filter out the short-term fluctuations. Is a price movement driven by fundamental development, like a major network upgrade or some new utility? Is it regulatory clarity, which de-risks the asset and opens new doors? Or is it just pure speculation, hype, or technical trading patterns that might fade pretty quickly? Understanding these distinctions helps you filter the noise and focus on what genuinely impacts long-term value, adoption, and the foundational strength of a project. Don't get caught up in every single percentage change. Instead, always ask why and what's the bigger picture. 3. Deeper insights, features, opinion, and learning resources.
Okay, beyond the daily headlines, this deep dive also surfaces some truly thoughtful pieces that go into more detail, explaining fundamental concepts and exploring strategic perspectives. This is where we get to the core of what's driving innovation and the underlying thinking in the Web3 space.
Yeah, what truly stands out to me in this section is the emphasis on both foundational education and forward-looking strategic discussions, which naturally leads us to ask, how do these deeper insights help us understand the future trajectory and potential challenges of decentralized technologies? They often highlight the core problems the industry is diligently trying to solve. A. the crucial role of interoperability.
There's a compelling opinion piece titled Cross-Chain Interoperability is Key for Seamless Web3 UX. It argues that without standardization, Web3 will remain like a Tower of Babel, where communication between chains is more akin to translation than transaction. That Tower of Babel analogy really sticks with me. With one tangible, way better interoperability would benefit you, the everyday user, not just the developer struggling with the tech.
That analogy perfectly captures the current fragmented state of the blockchain ecosystem, doesn't it? Cross-chain interoperability basically refers to the ability for different blockchains, which today are largely separate and independent, to communicate and exchange data or assets seamlessly. Right now, if you use an application on Ethereum and want to use an asset or data on a Solana-based app, it's often a clunky, multi-step process involving bridges in different wallets. It feels more like a complex translation effort, like the article says.
Yeah, it can be a real pain.
Exactly. A tangible benefit for you, the everyday user, would be a vastly improved and simplified user experience. Imagine easily moving assets, digital identities, or data between different decentralized applications, regardless of what underlying blockchain they are built on. Just like how you navigate different websites today without worrying about their underlying server architecture. It would make the entire Web3 experience far less clunky, more intuitive, and truly unlock the potential for complex, interconnected, decentralized applications that can leverage the strengths of multiple chains without creating these annoying silos. B. Understanding market forces in Whales.
We also see insights into significant market forces like Ripple and XRP shock triggers with whale demand. What's next? Whales are a term we hear a lot in crypto. Who exactly are they, and why does their demand for XRP matter so much?
Right. Whales are simply individuals or entities that hold exceptionally large amounts of a particular cryptocurrency. Their movements, whether buying or selling massive quantities, can significantly influence market prices due to the sheer volume of their trades. When a report indicates whale demand for XRP, it means these deep-pocketed investors are accumulating significant amounts of the asset. This accumulation signals strong confidence from major players, and their activity can often precede or amplify upcoming price movements, providing insight into the sentiment of those with substantial capital and influence in the market.
So, worth paying attention to.
Definitely. It's a key indicator for many traders because, well, where the whales go, the small fry often follow, or at least react.
And then there's this intriguing headline, Best Crypto to Buy Ahead of Friday's $6.5 billion triple witching. This sounds like something straight out of traditional finance. For someone new to this, how much attention should they pay to these more advanced concepts like triple witching in the crypto context?
That's a great question, and you're right. Triple witching is a term borrowed directly from traditional finance. In that context, it refers to the simultaneous expiration of stock options, stock index futures, and stock index options, which often leads to increased volatility in trading volume. Its application to crypto suggests a similar convergence of derivatives expiries impacting the digital asset market, often tied to Bitcoin and Ethereum options and futures. For someone new to crypto, understanding these concepts helps you grasp the intricate market mechanics and how derivatives markets play a significant role. It highlights that professional traders often anticipate and strategize around such events, which can indeed create significant trading opportunities or risks.
But maybe not for beginners to trade on.
Probably not directly, no. For most learners, the takeaway isn't necessarily to predict the exact outcome or to engage in complex derivatives trading, but rather to recognize that large institutional players and these sophisticated derivatives markets are powerful forces at play that can significantly influence short-term prices. It's more about awareness of these macro market drivers than direct participation, unless you're very experienced. See project-specific updates and strategic maneuvers.
Okay, let's look at some project-specific news now. Pump.Fund's $4 billion token launch postponed again amid legal woes. Pump.Fund is known for letting users easily launch tokens, so this postponement sounds significant. What does this tell us about the current challenges in the crypto space for platforms enabling new token launches?
Yeah, this headline really underscores the increasing regulatory and legal challenges faced by even popular crypto platforms, especially those operating in the often unregulated new token launch or meme coin space. A $4 billion valuation for a platform like Pump.Fund is substantial, highlighting the immense capital flowing into new projects. However, legal woes and postponements are direct consequences of regulatory scrutiny and uncertainty. This signifies that even successful platforms are not immune to external pressures, and such issues can significantly impact project timelines, investor confidence, and the overall viability of business models that might be seen as pushing regulatory boundaries.
The party might be winding down a bit.
It's a clear signal that the Wild West days of launching tokens with impunity are rapidly drawing to a close as regulators worldwide catch up.
Another interesting development. World App's parent company acquires Dawn Wallet, warns of an app wind down. This is an acquisition in the wallet space. What's the strategic play here, and what does a wind down mean for existing users of Dawn Wallet? They need to act, presumably.
Yes, definitely. This is a classic strategic acquisition, common in any maturing tech industry. Tools for Humanity, the company behind WorldCoin, is acquiring Dawn Wallet, an iOS-native Ethereum wallet. This indicates a focus on consolidation within the crypto wallet space and a drive to enhance the user experience by bringing more features or a larger user base under one roof. For existing Dawn Wallet users, the wind-down warning is crucial. It means the app will cease operations, and they will need to transition their assets and data to another wallet, likely World App's own wallet, within a specified time frame. This highlights that while corporate mergers and acquisitions in crypto can lead to improved services and market concentration, they also require users to adapt to changes and be proactive in managing their digital assets. Always be aware of service changes and plan accordingly.
Good advice. And we've seen Hashkey backed Avail drops over 8% after Binance Alpha listing. A listing on a major exchange like Binance is usually seen as good news, so why the drop? And what is a modular blockchain like Avail? That term pops up more now.
You're right. Securing a listing on Binance Alpha, a major exchange, is typically a positive development that increases liquidity and exposure for a project. However, initial price drops after such listings are not uncommon at all. This can be due to that buy the rumor, sell the news behavior, where traders accumulate the asset anticipating the listing, then sell off once the news is confirmed to take profits. Other market pressures or broader downtrends can also override the positive news sometimes. As for Avail being a modular blockchain, this represents a crucial architectural shift in blockchain design. Instead of one single blockchain trying to do everything like a general-purpose computer, modular chains split functions execution, data availability, consensus into specialized layers.
Like different lanes on a highway.
Exactly like that. It's like moving from a single, often overwhelmed highway to a multi-lane specialized network. This dramatically increases scalability and flexibility for future decentralized applications. It's a core trend shaping the next generation of Web3 infrastructure.
Interesting. There's also news that China's Ant Group denies rumors about an RWA and stablecoin joint venture. Ant Group is a massive fintech player, so their denial is notable. What are real-world assets or RWAs in the blockchain context, and why is Ant Group's involvement, or lack thereof, significant?
Real-world assets, or RWAs, on the blockchain is a rapidly growing and really significant trend. It involves tokenizing traditional assets, think real estate, fine art, commodities, or even government bonds, by representing them as digital tokens on a blockchain. This allows for things like fractional ownership, increased liquidity, and greater transparency for assets that were traditionally illiquid or hard to trade. Ant Group, being a colossal fintech conglomerate in China, being rumored to enter this space is highly significant because of their scale and influence in traditional finance. Their denial, however, highlights the ongoing speculation around major financial institutions globally entering the crypto space, but also the inherent caution or sensitivities surrounding such moves, especially given China's historically restrictive regulatory environment concerning cryptocurrencies. It's a delicate dance between innovation and compliance for giants like Ant Group.
This next one is certainly future-forward, maybe even a bit sci-fi. Reddit is eyeing WorldCoin's iris-scanning orbs for user verification. That's fascinating and a little controversial, perhaps. What are the big questions that raises for you, especially concerning privacy and identity?
Yeah, this headline immediately brings up an important question about the trade-off between privacy and verifiable identity in the digital age. It's a core tension in Web3. WorldCoin's unique proposition is to use biometric data, specifically iris scans collected via their orbs, to provide a unique digital identity for humans on the blockchain, aiming to distinguish real users from bots. While it offers a seemingly unique solution to the pervasive bot problem on social media platforms like Reddit, the collection of such sensitive biometric data presents significant ethical, privacy, and security considerations that users absolutely need to be aware of.
Like, how is that data stored? Who controls it?
Exactly. How is that data stored? Who has access to it? What are the implications if it's breached? This move signifies a push by Web2 platforms to integrate Web3 identity solutions, but it reignites fundamental debates around the control and security of our most personal information. It's a bold step that comes with significant responsibility.
Okay, and on a more positive note for the industry, perhaps, Binance rolls out transparency tools showing insider token holdings. This seems like a direct response to past criticisms of market fairness.
It does indeed seem that way. This is a crucial effort by Binance, one of the world's largest crypto exchanges, to address concerns about potential conflicts of interest and market manipulation by internal staff. Historically, insider trading has been a concern in both traditional and crypto markets. By rolling out transparency tools that show insider token holdings, Binance is aiming to foster a fairer trading environment and build greater trust with its user base. This proactive step aligns with the broader industry's push for increased transparency and accountability, responding directly to past criticisms and aiming to mature into a more regulated and trustworthy financial sector. It's a positive sign for market integrity, educational content, and foundational knowledge.
Now let's look at the Learn section, which is incredibly valuable for anyone trying to get a grip on crypto. We have articles like, Is Crypto Banned in China? Full History of China Crypto Bans, How to Start with Bitcoin, A Beginner's Guide to Investing, and What is a Crypto Presale, The Ultimate Guide. From these types of learning resources, what's one fundamental concept you think everyone should understand before truly diving into the crypto space?
That's a great question. Drawing from these resources, I think the single most fundamental concept that everyone should grasp before diving into Q2S is the core difference between centralized and decentralized systems. Bitcoin was created precisely to offer a decentralized alternative to traditional centralized financial systems. Understanding this distinction informs everything, from the security risks you face, like the difference between holding assets on a centralized exchange versus self-custody in a decentralized wallet, to the core philosophy and governance of various blockchain projects. For instance, the China Crypto Bans article highlights how a centralized government can heavily impact crypto activity within its borders, but cannot shut down the underlying decentralized networks themselves.
Right, that's key.
The Beginner's Guide to Bitcoin would likely emphasize self-custody and understanding Bitcoin's permissionless nature, which are tenets of decentralization. This foundational understanding allows you to navigate the space with a more critical eye, make informed decisions about risk, and truly appreciate the revolutionary potential and sometimes the inherent challenges of blockchain technology. It's really the bedrock of the entire ecosystem. E-market outlook and price predictions from the Learn section.
The Learn section also touches on market outlook and predictions. We see AI for crypto prediction, myth or reality. What are the realistic expectations for using AI to predict something as volatile and sentiment-driven as crypto prices? Can it really work?
Well, the application of machine learning algorithms to crypto data for prediction is certainly an area of active research, but it's crucial to set realistic expectations. While AI can analyze vast amounts of data, identify patterns, and even execute trades at speeds impossible for humans, crypto markets are highly volatile. They're influenced by sentiment, regulatory news, unpredictable events, and sometimes outright manipulation. The article titled Myth or Reality kind of hints at the challenges. While AI can be a powerful tool for technical analysis or identifying arbitrage opportunities, predicting precise future price movements, especially over longer time frames, remains incredibly difficult. It's far from a crystal ball. Rather, it's a sophisticated tool that assists, but doesn't replace human judgment and understanding of market fundamentals and external forces. Don't expect AI to tell you exactly when to buy or sell for a guaranteed profit.
Good dose of realism there. We also have what is wrapped Steth, Ethereum derivative explained. What exactly is a derivative in the crypto space, and what specifically does Rust represent, and why is it useful for people?
Right, so in finance generally, a derivative is a financial instrument whose value is derived from an underlying asset. In crypto, this means a contract whose price depends on the value of a specific cryptocurrency or maybe a blockchain metric. Wrapped staked Ethereum, or RISE is a perfect example. It's basically a tokenized version of staked ETH. When you stake your ETH to support the Ethereum network, it's typically locked up and illiquid, right? You can't easily use it. RISE allows you to take your staked ETH and wrap it into a liquid token. This token can then be traded on exchanges or used in other DeFi protocols while still earning staking rewards from your underlying staked ETH.
So you get liquidity and yield.
Exactly. Understanding derivatives like RISE is key for navigating more advanced DeFi strategies, unlocking liquidity from stake assets, and managing risk within complex, decentralized financial ecosystems. It allows for greater capital efficiency by letting you utilize your staked assets in new ways.
Okay, there's also what is COTI, a complete overview of its tech, token, and market impact, and then Sky Price Prediction. Is now the time to invest in the rebranded MakerDAO? What do these specific project deep dives tell us about the industry's landscape beyond just the major players like Bitcoin and Ethereum?
These articles highlight the incredible diversity and constant innovation within the crypto space beyond just the big names. COTI, for instance, is not a general-purpose smart contract platform, but focuses specifically on enterprise payment solutions using a unique directed acyclic graph, DAG architecture, rather than traditional blockchain. This shows the industry's focus on solving specific real-world problems with tailored technological solutions. The Sky Price prediction, referencing a rebranded MakerDAO, is significant because MakerDAO is one of the oldest and most fundamental DeFi protocols responsible for the DI stablecoin. This signals that even established, large projects undergo significant evolution and rebranding, which can create entirely new investment opportunities or risks. It reflects a dynamic ecosystem where even the giants are constantly adapting and reinventing themselves to stay relevant and competitive. It's a world of constant reinvention and niche innovation. 4. Partner content. The world of sponsored predictions and promotions.
Now, this next section is truly interesting because it gives us a peek into the more promotional and speculative side of the crypto news cycle, what our source labels as partner content. It's really important to understand these for what they are. Sponsored articles, often designed to generate hype and interest in particular projects. Buyer beware, essentially.
Yeah, a key observation here is the sheer volume and the, well, very common themes that emerge from these sponsored pieces. This naturally leads us to ask, what do these promotional materials truly tell us about the broader aspirations and, frankly, aggressive marketing strategies within the crypto industry? They often provide a fascinating window into the prevailing narratives and the tactics used to attract capital in this fiercely competitive space.
And the promises are incredibly bold, almost fantastical sometimes. We're seeing themes of just outsized returns and next big things everywhere. Think of headlines like whales shift to XYZverse, predicting a 15,000% surge by 2026, claiming whales are shifting from established players like AVAX and Polkadot, or the extremely enticing meme coins under $2 billion market cap ready to skyrocket to $40 billion in the next bull run. Wow. Some even claim you can turn 1K into $1 million by 2035. It's a dizzying array of sensational claims, from new pre-sales sparking speculation of 10x returns to coins eyeing a 10,000% moonshot. What an array of claims.
You've highlighted the commonality perfectly. When we analyze these partner content pieces, several recurring themes just jump right out. There's an overwhelming prevalence of incredibly high, almost sensational predictions. Skyrocket, 10,000% surge, 10x return, turn 1K into $1, and even that wild 28,905% in 2025. This is a hallmark of promotional content designed specifically to capture attention and exploit that fear of missing out, or FOMO.
Definitely plays on FOMO.
For sure. Secondly, there's a strong emphasis on new or pre-sale projects. Many of these articles push emerging tokens, often positioning them as superior, undiscovered alternatives to established and perhaps more mature coins like AVX, Polkadot, Cardano, or XRP. They leverage existing brand recognition of major coins to give credibility to the new speculative asset. Thirdly, they employ specific marketing narratives. Phrases like whale shifting, the next big layer one, betting on builders, or highlighting hybrid architecture, these are all crafted to build a compelling story around the project, hinting at technological superiority or institutional backing to attract investment. Finally, the inclusion of exact, often incredibly ambitious percentage figures or financial targets like 15,000% surge or a $600 million goal, while attention-grabbing, are characteristic of promotional content. They're designed to be highly persuasive but lack the rigorous, objective analysis you'd expect from independent journalism.
So what should you, the learner, truly take away from these highly optimistic, almost fantastical predictions we're seeing in the partner content? How do you approach this information critically to protect yourself?
It's absolutely crucial to understand these for what they are. Marketing materials, not unbiased, objective analysis, or financial advice, period. While some projects may indeed see significant growth in a bull market, these figures are speculative targets based on promotional narrative, not guarantees. They highlight the highly entrepreneurial and sometimes aggressively promotional strategies prevalent in the crypto space, where projects compete fiercely for investor attention and capital. The key lesson here is critical thinking. Always, always verify information independently. Conduct your own thorough research into the project's fundamentals, team, technology, and actual utility, and never invest based solely on sensational predictions, especially from sponsored sources. These articles can help you understand what new projects are vying for attention and what kind of narratives are circulating in the market, but you must approach them with a significant grain of salt and a healthy dose of skepticism. Your due diligence is your first and best defense.
the industry announcements, press releases, and events.
Finally, let's quickly skim through some of the official press releases and event announcements. These give us a sense of new product launches, partnerships, and key events happening across the crypto industry. It's less about market movements and more about the ongoing development and expansion of the ecosystem, the real builders and innovators at work.
Right. If we connect this to the bigger picture, these announcements truly reflect the continuous innovation and the growing maturity of specific platforms and protocols. This naturally leads us to ask, what do these developments tell us about the industry's focus areas right now, and where is the underlying technology heading? They reveal where resources and efforts are being concentrated, often signaling future trends.
We see a flurry of activity across several categories. In terms of new features and updates, FUN token announces a deflationary update and achieves certification, which is a big deal for security and trust. BingX's new dual investment offering has already seen an impressive $1 million in user participation. For new launches and platforms, Wagium iHub is set to launch INF OFAI on June 23, claiming memes, markets, and AI will drive real utility. Angel Twin officially announced its token generation event and Angel listing on Uniswap. Then there are industry events and collaborations. LBank is hosting an LBank X AI Web3 Innovation Forum, explicitly driving crypto and AI convergence, a really hot topic right now. Barry Silbert and Bittensor are dominating headlines in Paris at Proof of Talk 2025, again focusing on AI's next frontier, showing how pervasive AI is becoming. Curium Global Intelligence announced CDAO Chicago 2025, another major conference. And Dexport is bringing the FIFA Club World Cup to Web3 sports fans, showing expansion into mainstream entertainment. In company milestones and transparency, Gate released its May 2025 transparency report, signaling a brand revamp and strategic acceleration. Brokokil topped $5 million volume as its founder burned 81.5% of tokens, quite a burn, and its CTO met CZ at a Binance event, often a sign of future developments. Finally, in emerging technologies and use cases, Protocol AI is capturing a $16 billion AI agent market with a platform that turns anyone into a Web3 developer. It's clear the industry is buzzing with new initiatives and events. What's the overarching message you get from this flurry of activity, and what does it signal for the future?
This ongoing stream of press releases highlights the relentless pace of development and innovation across the entire crypto and Web3 industry. It really paints a picture of a multifaceted industry. It's simultaneously focused on enhancing user engagement through new financial products like dual investments, launching new platforms and tokens with diverse utility, and deeply integrating cutting-edge technologies like artificial intelligence. We also see expansions into mainstream sectors like sports with Dexport, alongside a continuous drive for greater transparency and security through reports and certifications. The significant token burn by Broccoli's founder is also a classic move to reduce supply and potentially increase value, while the meeting with CZ shows the importance of key industry figures and exchange relationships. Taken together, it signals robust growth and diversification across the board, moving beyond just pure financial speculation to building real infrastructure, applications, and integrating with other transformative technologies like AI. The industry is far from stagnant. It's building and evolving at a rapid clip. Outro.
Wow, that was a truly comprehensive deep dive into the latest crypto news and market insights. From the minute-by-minute price movements of Bitcoin and the altcoins, to the grand narratives of regulation, the ever-present security challenges, and the fascinating technological evolution, like AI integration and modular blockchains, we've covered a remarkable amount of ground today.
Yeah, our goal was to give you that shortcut to being truly well-informed, providing not just the headlines, but the deeper context and the so what behind each piece of information. We've seen how established players like Ethereum and Bitcoin are evolving and consolidating, how new projects are emerging with innovative solutions, and how global events, regulatory shifts, and even sophisticated cyber threats continue to intersect with and shape the decentralized world.
So, as you continue to navigate this dynamic space, what's crucial for you to focus on? Given the constant interplay between rapid technological advancements, evolving regulatory frameworks, and an ever-present speculative fervor that drives so much of the market, what is the single most significant factor you believe will shape the crypto market's trajectory in the coming year? Is it the continued push for greater cross-chain interoperability to create a seamless Web3 experience? Is it the clarity or frustrating lack thereof from global regulators that could either stifle or accelerate adoption? Or perhaps the sustained and growing influx of institutional capital that's increasingly viewing crypto as a strategic asset, something to ponder as you continue your own deep dives?